Good afternoon. Let us start with the sixth lesson, which is cost of capital. With this, we'll also start our third unit. The cost of capital we've already discussed in the classroom. It mainly covers two basic topics: cost of capital and weighted average cost of capital. Let us understand what the cost of capital means. Whenever, for example, when you're going somewhere and you're hiring a car, then car for 2000 rupees per day, and you take 2 days to complete your tour. Within 2 days you will go there and you will come back. So the person from whom you have taken your car on rent will have to pay 4000 rupees to him, plus you have to return back his car as well. The same is with the money. When you take money from someone, you have to return back the money, plus you have to pay him something on top of that as a sum to use that money. That money which we pay to use that money is called as cost of capital. For example, if you take money from someone and you use it for your purpose, if you take funds from someone and you use it for your purpose for 3 months, then you will have to pay interest for these 3 months to him, and that will be cost of capital. So cost of capital means long-term sources of finance, and cost of capital means the cost which a company has to pay to use those long-term finances. Now let us go ahead. Cost of capital, it refers to the minimum rate of return a firm must earn on its investment so that the market value of the company's equity shares do not fall. Let us understand the statement. First of all, let us understand when the company's equity shares market value will fall. When there will be adverse, when there will be bearish perception related to the shares of the company. When will it happen? When it will not be able to pay off its debt, when it will not perform well. So the minimum rate of return which an investment must earn so that it can at least pay back its cost is cost of capital. Let us understand. It is the minimum required rate of earning or cutoff rate of capital expenditure. It means, for example, you have taken a loan at 9% at 9% interest rate, then you will have to earn at least 9% rate of interest to pay back that 9% rate, and that is the minimum required rate of earning. Now, what are the characteristics of cost of capital? It is not a cash cost. Minimum rate of return, there has to be it is a minimum rate of return, and consideration of risk premium. Yes, of course, because risk premium is the sum which a firm gets, which a company gets because it is taking some risk. What a lender is doing in this case is he's taking the risk by lending his money to the person who needs that money, and then he's taking premium for that. Factors affecting cost of capital: general economic conditions, market conditions, firm's operations and financing decisions, and amount of financing. Importance of cost of capital. Cost of capital helps in capital budgeting decisions. We'll understand capital budgeting in the next unit in detail. Capital structure decisions, it helps us to decide what kind of debt equity mix we want to have in our capital structure. Then other managerial decisions. Evaluating financial performance. It also helps us in evaluating the financial performance of the company. Problems in determination of cost of capital. First is computation of cost of equity. Most of the people, they think that equity does not carry any cost. That is wrong. In fact, equity is costlier than debt. Then computation of cost of retained earnings and depreciation fund is again a problem, because the retained earning, again, it is perceived that it is already earned money and does not have any cost, but that is wrong. Retained earnings have opportunity cost associated with them. Future cost versus historical costs. Again, that becomes a problem. Whether to take future cost or to take historical costs. Problems of weights. It becomes very difficult to assign weight to various components of cost of capital. Controversy regarding dependence of cost of capital upon the method and level of financing. There is a controversy whether by increasing the debt component in the capital structure, can we increase the market value of the can we increase the value of the shares of the company. Now, if you look into this chart, cost of capital, there are four kinds of capital we have: a debt, cost of preference shares, cost of equity shares, and cost of retained earning. Now, debt are of two types: redeemable and irredeemable. And then again, because debt is the interest on the debt is paid before tax, it can be cost after tax and cost before tax. Then cost of preference shares, again these are of two types: irredeemable and redeemable. Cost of equity shares are always irredeemable, so that is only one. And cost of retained earnings also is there. So we'll discuss about these four things in our lecture. Cost of debt. Cost of debt, if you look into cost of debt, irredeemable, before tax is cost of debt is equal to interest upon net proceeds. After tax, it becomes interest into 1 minus t upon net proceeds. Net proceeds is the debt amount which a company gets on its hand after deducting all the issuance charges, etc. Cost of debt, when we talk about redeemable debt, before tax it is cost of debt is 1 plus RV minus NP divided by N divided by RV I plus this is not 1, this is I plus RV minus NP divided by N divided by RV plus NP divided by 2. After tax, the same. Similarly, we do I into 1 minus T plus RV minus NP divided by 2 whole divided by RV plus NP divided by 2. Cost of preference shares, irredeemable. Cost of preference shares is preference dividend divided by net proceeds. In case of redeemable, it is cost of preference share is similar to what we have in cost of debt, redeemable, D plus RV minus NP divided by N into R divided by RV plus NP divided by 2. Cost of equity shares is DPS upon MPS plus G, is according to the growth model. And cost of retained earnings is similar to cost of equity. Only thing is you deduct 1 minus T, and cost of retained earning is you multiply it with 1 minus T and 1 minus B, and B is the brokerage cost or whatever the issuance cost is, securities issuance cost is. A weighted average cost of capital. The overall cost of capital calculated as a weighted the average cost of various sources of financing is weighted average cost of capital. For example, a company is using debt and also equity. Then weighted average will be combined cost of both the components of the capital. Weighted average cost of capital is represented by weightage of equity into cost of equity plus weightage of debt into cost of debt into 1 minus T. What is the advantage of weighted average cost of capital? Is a measure of interfirm comparison. It is used for valuation of a firm, a criterion to accept or reject a new project, and used to hurdle rates. Disadvantages: cost of equity is difficult to calculate. Unrealistic assumptions like D upon E mix will remain constant. Increasing debt to achieve lower weighted average cost of capital is problematic. Again, this is trading on equity. Here with this, we come to end of the cost of capital. We'll deal with more of numericals. Please go through this slide. It's very, very important. All the slides are very important here. I hope you all enjoy the session. A weighted average cost of capital numericals are very important. We will deal with numericals in a separate video. And thank you for the time being. Thank you.